When you get rejected for a loan, it's easy to assume the problem was your pitch or your timing, but it usually isn't that. The real rejection trigger is almost always hiding somewhere in your financial documentation. So here's the direct answer. Lenders are not judging your idea. They are running a structured credibility check to determine whether your financials make repayment capacity visible. Before anyone reads a business plan, a lender is looking at 4 things: your cash flow, your credit history, your business age, and your sector risk profile. Credit history matters because missed payments or defaults signal that history could repeat. Business age matters because newer businesses have less data to assess, which means more risk. And sector risk matters because lenders apply different risk lenses by industry. But cash flow sits above all of them. It's the single clearest signal of whether your business can actually service the debt. And that is exactly where most applications fall apart. A lender needs to see one thing clearly: that your inflows reliably cover your outgoings and leave enough headroom to service any repayments. If your cash flow forecast is missing, vague, or inconsistent with your bank statements, then that gap signals risk, regardless of how healthy your business actually is. Think of it this way. A viable business with poor cash flow documentation looks identical to an unviable one from a lender's perspective. They can't see the difference on paper. Take a small retail business that is genuinely profitable. If the owner submits a forecast that does not account for seasonal dips or shows inflows without explaining the timing, a lender can't confirm repayment capacity with any confidence, and so that application is likely to fail, not because the business is weak, but because the documentation did not make the strength visible. This is why so many rejections can be fixed. The problem is presentational, not always fundamental. But it is worth being honest about one thing. Not every rejection is fixable by better documentation alone. Sector risk is real. Lenders apply different risk profiles by industry, meaning a retail business and a technology business with identical financials may be assessed differently. Not because one is better ran, but because its perceived sector volatility differs. Beyond sector, genuine credit risk and early business stage can be hard limits for traditional lenders. If your business is under 2 years old or carries significant debt, a high street bank may simply not be the right lender at this stage. But that's not a dead end. Alternative lenders and asset finance and government-backed schemes exist precisely for these circumstances. The key here is knowing whether your rejection reflects a fixable presentation gap or a genuine stage mismatch. So, here's the practical decision rule. Before you apply, audit your cash flow documentation against what a lender actually needs to see. And there's 3 questions to ask yourself. Number 1, can a lender clearly see your monthly inflows and where they come from? Can they see your outgoings, including any existing debt repayments? And third, can they see explicit headroom, meaning the gap between what comes in and what you owe, including any new repayments? If the answer to any of those is no, then fix the documentation before you submit. Do not fix the pitch, fix the presentation. A rejected application also leaves a footprint on your credit file, so applying before you're ready can make the next application just a little bit harder. Get your numbers legible first. If you can show repayment capacity clearly on paper, you have addressed the most common reason applications fail. If that was of value, subscribe to the channel for one real business question answered every video. For the same clarity in writing, the website and newsletter is 5minutebusiness.com.